I would say if you're going to own Bitcoin, you need a 4 year or longer time horizon. If you're going to own amplified Bitcoin, a company that aims to be more volatile than Bitcoin, you can't have a lower time horizon. So you probably need a longer time horizon. So we manage the company such that we think 10 years from now, we're going to create an insane amount of shareholder value. And that doesn't mean we're looking for 10-year payoffs. We're generally thinking if it doesn't return what we expected within 4 years, we'd be very disappointed. But we never do anything where we demand to get the payback in 4 months. And so we don't have a 4 month time horizon or even a year time horizon. And we think that generally, I would say if your time horizon is 12 weeks, you should own the STRC, right? You really should go to the short end of the risk curve and the short end of the duration curve because that one we're trying to strip volatility away. And if your time horizon is 10 years, and if you are Bitcoin maxi, then maybe you like the equity or you like Bitcoin. Um, the credit instruments, I would say if we wanted to raise the max amount of capital, then we could do two things that we don't do. One thing we could do is we could just open up the ATM and we could sell stock at any MNAV any week all the time. And what you've seen is we don't do that. You know, after the red sweep, when there was a massive enthusiasm, we would sell 1 billion or $2 or $3 billion of stock, like a billion in a week or 2 billion in a week. And so you see, we're not shy when the market is strong and the premiums are high. We would go very hard, but you see a lot of weeks where we sell nothing. And we could have sold $1 billion of equity a week. We chose not to sell any equity. If the equity is weak and it's crashing, it's almost certain. In fact, it is certain we're not the ones doing it, right? We're watching, right? Because our view is we only sell into strength and we only sell into strength when we like the premium. So we have actively decided we don't want to maximize capital by selling equity. And then I think the other thing is just like we could raise $1 billion of equity in a few days if we wanted to. I could also pick up the phone and I could raise $1 billion overnight in debt. If I just said we wanted to do a pipe deal with a debt investor, I would have 12 firms over the weekend. And by Monday morning, we could have raised two, three, four, five, $6 billion. They would be licking their chops and delighted to give us the capital. They would want to be senior to all the other creditors in the capital structure. And what they would do is they would undermine the creditworthiness of the preferred instruments that we actually want to sell. So you could just assume with our 75 billion of capital right now, we've already chosen not to raise 20 billion or 30 billion. We could be $100 billion, but we'd be 100 billion and the risk profile, the leverage wouldn't be 11%. The leverage, would go up, and so we actively decided that we don't want to generate leverage, right? We're literally on a path to drive leverage down. We're also on a path, we've decided we don't want to do deals that don't have positive BTC yield. But more importantly, we're on a mission. The mission is to create the digital credit market. So I think the company has two speeds. Well, maybe more than two speeds. When we're coasting, when the credit markets don't offer us anything compelling and the equity markets aren't compelling, we are coasting. And in my mind, I think that that is a $75 billion company growing 30% a year for the next 20 years. So that is in idle. And then for those of you who know me, I believe in the Hippocratic Oath, do no harm. And so the risk-free rate, the company is going to get the 30% a year for 20 years if we take no risk. So what can we do where we feel like it's worthwhile? And of course, if we sell credit, we can take that 30% to 40% or to 50%. But we have an agenda here. The agenda is not to artfully manage the balance sheet. And it's like if you told me, well, you could issue $10 billion of junk 5 to 7 years and roll them every year and roll them every quarter, and you could pursue a credit strategy based on debt that gets you a lot more capital, and you're continually rolling it. And you would do that with 144A offerings. We could like fire up a $2 billion 144A offering next week, and we just go do it. But the point is, we don't want to be the revolutionary company that adopted digital capital that grew the company with conventional traditional credit. We want to be the revolutionary company that discovered digital capital that then went on to discover and found the digital credit market. And, when you're just rolling a bunch of 5 to 7 year bonds, and when you're opportunistic, then you're careening toward the future with an advantage. I want MSTR to stand for monster. We want to create a monster company. We don't want to careen toward the future with an advantage. We don't want to be the talented fighter, that kind of wins and loses and mostly wins and is a little bit sloppy and undisciplined. We want to create the digital credit instruments that are 2 to 4 times better than everything in the $300 trillion market. And we want to eat the world, right? And we want to sell $100 billion of them. And after we sell 10 billion, then 20 billion, then 40 billion, then 80 billion, when people go, well, aren't you levered? We want to say, well, actually our leverage is zero. Huh? What? Wait, what? We have 30% amplification, but we don't have 100 billion of debt. We have 100 billion of equity that happens to actually amplify the common equity. Let me educate you on a new way to build a company. So I would say you want to boil that down. It's a very disciplined growth strategy. We would rather coast and have a bulletproof balance sheet and a $75 billion company growing 30% a year than to stretch for capital or stretch for some kind of yield, but undermine the balance sheet and take on credit risk. Because someone says, I'll give you $10 billion tomorrow, and it's senior to STRC. We just created volatility, and we crumpled the credit of the instrument that is going to provide a comfortable retirement to 1 billion people. I don't want to be the dude that made a good trade that made 25 or made $50 billion by trading Bitcoin by using cheap corporate money. We don't want to be the company that made 25 or $50 billion or a Hail Mary, or maybe we lost it by whatever, borrowing money, however we can get it to buy Bitcoin. We want to be the company that provided a comfortable retirement to 1 billion people and changed the world, right? We want to change the monetary system. I want everybody to get up in America and say, I'm not getting paid 10% tax deferred from my bank or from my money market. That's not fair. That's an abomination. I'm going to tell all my friends that I'm so mad about it. I'm going to go tell my 100 people that I know, they all need to pull their money out of the money market. They need to buy Stretch. And we want to be in a position where we can accommodate that demand. And so what you have is the money that comes easy is always the money that comes with strings attached. And I've learned that over 35, 40 years. And I think that people in the Bitcoin treasury market, they're learning it now. The easy money is the toxic money. What you really want is you want to create a revolutionary new product that solves a problem for $300 trillion of investors and for billions of people. And you know what? When we sell $1 billion worth of digital credit, they're giving us the money forever, and we're taking no credit risk. But the quid pro quo is we're giving them 10% tax deferred, right? And so I would rather pay 10% tax deferred and get the money forever than pay 5% and get the money in the form of a junk bond and pay a taxable 5% coupon, even if you wanted to give it to me. And Ben, you can see the obvious reason why. The world's full of 50,000 companies that will give you the 5% taxable. How many companies are in the world that will give you 10% gleefully, enthusiastically as a rock dividend, and then do everything in their power to actually issue more dividends? So for us, the credit is the product, right? The aspiration or the offering is a comfortable retirement to everybody who's a credit investor. That's the offering. If we can do it by selling equity, we will. But when the equity, when the equity is dilutive, we won't. And we won't do debt because debt is a conventional credit idea. It's a 20th century idea. I think I laid out with my 7 differentiators for digital credit. We think that digital credit is an inversion of everybody's value system. Every other credit issuer in the world gets up and says, how do I cripple the credit and pay you the lowest coupon and maximize the advantages to my company? And we get up every day and say, how do we create the greatest credit instrument that pays the highest tax equivalent cash flows that's going to be best for the buyer, right? For the investor. So